What if your healings come through tears? What if 1,000 sleepless nights is what it takes to know you're here? What if trials in this life are his mercies in disguise? And I think that's the way it is. I think the Lord has a program for us. I don't know if any of you have read the book Charlie's Monument. But I believe that each of us has an individual plan. Each of us has a mission. And the Lord knows exactly what we need to be able to fulfill that mission. And I believe those trials are his mercies in disguise. That's what it takes it's what it takes for us to the experiences we need to become like him. So, just a thought. Okay, retirement. Today's our second day on retirement. What do you want out of retirement? You ever thought about that? At retirement, we retire, but retire to what? Again, this is another article. This is Jonathan Clements, Wall Street Journal, November 27th, 2006. It says, off your rocker for a happy retirement. Don't swap work for the front porch. Here's the latest thinking on retirement. Don't. It doesn't mean you shouldn't retire from your job, but what will you retire to? Many people give scant thought to what they will do once they quit the workforce, and the result can be depression, mental deterioration, declining health, and possibly a shorter life. To avoid that fate, experts say you need to treat retirement less like a lengthy vacation and more like a career change. So what do you think? What are you going to do? It says, we spend 40 years plugging away at our jobs, struggling to amass enough money so we can enjoy a few fun-filled decades at the end of our lives. Yet having a heap of money doesn't guarantee a happy retirement. There are three different reasons. Reason one, no matter how much you hate your job, it's likely providing you with more than just a paycheck. There's relationships. There are things you're working on, friendships and colleagues. Second, if you're married, retirement means you'll suddenly be spending more time with your spouse. There's a potential for challenges there. Number three, many folks have the wrong notion about what retirement's all about. So it's what I call vacation confusion, Professor Sundstrom says. They think retirement is a rest well-deserved. Once you're rested up, now what? So it's easy to identify retirement's pitfalls, but the question is, harder to avoid them. Want to improve your chances of a healthy retirement? And they say they chew on these four questions. Question one, what is your purpose? People may not know because they buried them so long ago. Many people give up their passions early in life. So we need to figure out what our purpose is in life. Number one was what are your passions? Number two, what is your purpose? The little thought, you can probably put together a list of activities you enjoy, but that alone isn't enough. You feel fulfilled when you're doing something both important and satisfying. Question three, how will you replace the stimulation at work? So when you're in the workforce, you have to get yourself to a job every morning. And they say the most important factor in a successful retirement is the strength of your social network. And question number four, what's your new role at home? Before you quit your workforce, you should hash out a slew of issues with your spouse, including how much you will travel, who will handle which chores, how much you will each be able to spend. But as you think about retirement, these are important things. It's kind of interesting for my wife and I to be talking about these things, because with the new change in the mission rules, we're going to retire in 6 years. At least we're going to go on a mission in 6 years. And then the questions on what do we do? What do you do after that? So it's kind of interesting things and things we need to think about. Again, let me go over those four questions. Again, what are your passions? What is your purpose? How will you replace the stimulation at work? And what's your new role at home? Important questions. Okay. Let's start with a case study. Bill's going to be graduated in April. Two similar offers, both located in San Francisco. He would like to stay with. Company A has a 401k, 100% match up to 4% of his salary. Company B, a 401k, no match, but a defined benefit plan with a formula based on average salary, a factor of 1.5 years, and years of service up to 30 years. Assuming the salary is 50% for either, which is the more attractive retirement package? And can he participate in other plans? Anyone have a similar challenge like this? Thoughts? So that's our introduction today. How do we look at plans? How do we understand plans? Not only from the point of view of someone who's graduating, but the point of view of what are the available options out there? Remember we said there was 3 questions. Question 1 for retirement planning, number 1 is how much am I going to need? Question 2 is what are the available vehicles? And question 3 is how do I tell if I'm on track? So today what we're going to do is we're going to address more of those available vehicles. Really 2 types of employer qualified plans. What does qualified mean? They say employer qualified plans. Why do those plans have to be qualified? And they're qualified to do what? Are they qualified to give us tax benefits? And the answer is yes. So there's employer-funded pension plans. These are those defined benefit plans which are getting rarer and rarer. And there's employer-sponsored retirement plans, which the employer sponsors, and those are what we're most familiar with. Defined 401ks are things that we're more concerned with. So here's how the different plans, and here's how they work. Defined benefit, employer's contribution actuarially determined. Defined contribution specified by format. Benefit amount is certain, contribution amount is uncertain. Internal Revenue Code limits apply, and this is maximum benefits funded, and these are contributions. And then here's a number of different types of plans. And what we'll do today is we'll kind of go over these plans. Now realize if you've got different types of businesses can decide on the type of retirement plans they have. So notice here, defined benefit plans, basically all of these different types of entities. Notice that some of these you can't have. So we've got defined benefit plans, defined contribution plans, and we divide those into discretionary contribution, fixed contribution, and employee contribution.
Where does an LLC fit into that?
We
do type of business.
Someone want to help me out with that one? My guess it could be either a partnership or a sole proprietorship. Probably could be a professional corporation as well. That's a good question. I don't know the answer to that. And the question too is how much can you get each year out of this? And so, for defined benefit, the maximum is 100% or $205,000 per year, or up to $51,000 for indexed. So the amounts that you can do are differ depending on the plan. And we can see how these have changed. Really, there's been a shift in employer qualified plans. In my parents' era, you would go with a company and you'd stay with them for 50 years and you'd have this defined benefit plan. And then you would get that for as long as you lived. And it would guarantee a certain amount of money for, depending on how long you worked and your salary and things like that. With defined contribution plans now, what firms are realizing is there's a lot of risk through these defined benefit plans. And so they're shifting to the defined contribution plans, which places the risk not on the institution, but places the risk on the individual. So we're seeing fewer defined benefit plans today. And again, less than 20,000 today. My guess it's probably less than 15,000 today. So in essence, what's happened is risk has been transferred from the corporation to the individual, which is even more important for us to worry about and to be concerned about. Benefits to employer qualified plans. Employer contributions are tax deductible, not taxable to the employee in the year given. Again, these are deferred benefit plans. And really, earnings aren't taxable until retirement. And so that's kind of our framework. Defined benefit, defined contribution plans. And then actually what's happening is we're seeing a shift. The shift is moving toward defined contribution plans, which makes what we're doing even more important. So let's talk first about the one that there's not this many out there. If you can get one, if they have defined benefit plans, they're very good. So a defined benefit plan is funded by the employer. The payout amount is guaranteed. They guarantee you a certain amount, depending on the formula, depending on how many years you stayed with the company, and depending on your salary. Employees do not contribute, bear no risk. They receive a promise.
What if the company goes bankrupt?
What happens if the company goes bankrupt? So you've got the pension guarantee corporation, but will they give you everything that's been promised by the company? No, but there's probably some minimum benefits there. So realize it's just a promise. Can the company change it after you retire? The answer is yes. So be aware. Two different types of plan. One's a defined benefit plan, and the other one's a cash balance plan. Defined benefit plan is, it works on years, salaries, some factor, and number of years of service. For example, if you had 25 years of service, the factor was 1.5, and your ending salary was $60,000, you would be guaranteed $22,500 a year for as long as you live. Now, if you decide to take that differently, say you want to take both you and your spouse, instead of $22,000, you might get $20,000 a year. So it can be nice to have this type of a framework if it's available to you. Advantages, you don't have to contribute. Some plans can be 30 to 70% of final salary. Got a brother who works for the state of California. He's in physical facilities, and he's hoping to retire at about 40 or 50% of his salary at retirement. So they can be really nice. Disadvantages, it's all taxable income. The firm can change policies even after you retire. And then the challenge here is some plans are unfunded, meaning funds come out of current company earnings, and if the company doesn't earn it, there can be some real problems there. So cash balance plans are kind of a transition plan. So what happens, a lot of funds, companies that had defined benefit plans are kind of moving all the new employers over to cash balance plans. And what they do is the employer will contribute a specific amount every year, and then plus some low but guaranteed rate of investment. So accounts grow at some predetermined rate. Employees don't make any investment decisions at all. An advantage is you don't contribute. The amounts are higher, and also the plans are portable. And the disadvantages, benefits may be different than the defined benefit plans. So those, if you've got them, those would be good things. If that's available to you. What we're more familiar with is these defined contribution plans. And then employer contributes. The employee may or may not contribute. But the point here is with the corporation has no more responsibility once they've either matched the contribution. So that's our challenge here. Generally, there are three different types. One is discretionary contribution plans, profit sharing, stock bonus, employee stock ownership plans, or money purchase plans. Fixed contribution plans, which are things such as thrift and savings plans, a target benefit plan. And the last one is employee contribution plans, which are what we're familiar with, 401ks and 457 and 403b plans. So let's go through each of these here. Discretionary plans, profit sharing plans. Contributions vary year to year. I worked with a company called Emerging Markets Investors Corporation in Washington, D.C., and we had a profit sharing plan. So the nice thing at the end of each year, they would get down and they would say, okay, we have this amount of money, and they would split it up between the employees. And the nice thing is we didn't have to contribute to that. Stock plan is where contributions are made with employee shares of stock. What's the challenge with this type of plan? Yeah, lack of diversification. Third, they have money purchase plans. Here's where the employer contributes a percentage of employee salary each year, not dependent on company profitability. The nice thing is anything the company contributes is amount that you don't have to contribute. Remember our goal of 20%? If you have a company that matches 1-for-1 up to 5%, you really only have to save 15% and the company will match the other 5%. So if you can find companies that have these plans, it can be very helpful. Fixed contribution plans, what happens here is the employer matches a percentage of employee contributions. And again, we've talked about how the important thing is get as much free money as you can. Generally, it's for employees of federal service. Target benefit plans, what they do is they establish a required contribution once you come with the company. They figure, okay, you're 35 right now, you'll retire at 65, we probably need a certain amount here. And they'll make that delineation there. And here's the one that we're familiar with. These are employee contribution or salary reduction plans. This is your traditional 401k, Roth 401k. Again, before tax dollars, reducing your taxable income if it's a traditional 401k or a 403b. Earnings accumulate tax deferred. And this, I think the statistic's a little old, 89% over the events of 2008 to 2012. I think that dropped down to about 69%. But we're actually seeing those coming back a little bit here. There's really three different types of plans. They're all really very similar. And what the government's trying to do is they're trying to move all the statistics very similar. So you've got the 401k, and this is mainly for private companies, things like that. You've got the 403b, nonprofit tax-exempt companies and institutions. And then you've got the 457 plans, which is very similar to the 401k except for state and municipal workers and tax-exempt organizations. So realize three different retirement plans, and what the government's trying to do is trying to make sure all the frameworks are very similar. So we're seeing a merging of these types here. Differences between the 401k and the 403b, it's mainly just, the Roth and the traditional salary reduction plans. You know, we've talked about this. No tax deferral on the Roth. Distributions of contributions because you've already paid taxes on it. If you need to take money out before retirement, you can do that without taxes and without penalty. Roth plans Roth plans don't have the mandatory distributions. We'll talk about that. In actuality, Roth 401k plans do have a mandatory distribution, but if you roll that out at retirement into a Roth IRA, there's no mandatory distributions. And here's an important point. If you have a Roth 401k, like I've got a Roth 401k here at BYU, when BYU matches, do they put that into it? Is the match in a Roth vehicle, into my Roth 401k, or is it into a traditional 401k? It's actually in a traditional one. And then the final thing is Roth plans allow you to save more because you pay the taxes outside of the investment vehicle. And again, with these salary reduction plans, employees direct the funds into different asset options. So generally, if you're working for a company and they have a 401k, you don't get to go and select, okay, I want a Vanguard fund or a Fidelity. They give you a list of options. Sometimes it's usually between 10 and I think the big one I saw was like 55 different options. And you actually can go and select, okay, well, I'll put 10% into this one and 20% into that fund and things like that. So you have to select the options that you choose, or the options that they have available. Now, so what you might go is when you're, in this class we picked your different asset classes. A large cap and a small cap and an international. What you might have to do is say, okay, which of these funds gives me my large cap allocation, and which one give me my small cap, and which would give me my international and things like that. So advantages to employer: strong growth potential, greater sense of control, to employees. Can you take, once you put your money into a 401k or these type of qualified plans, is it portable? Can you take it with you when you move to your next job? And the answer is yes. So that's the nice thing here. Disadvantages: no guarantee of actual amounts. Yes?
How about pensions? Can you roll a pension over into your 401k?
No. So those defined benefit plans are a lot more sticky. And so, and what do they want you to do? They want you to stay with them for the whole time period here. Again, advantages: defined contribution to the employers, easier to administer, less government regulation. And what they're doing is they're shifting responsibility from themselves to the employer. And so here's just kind of a summary here. The different type of plans, who does the funding, what's the contribution, who is eligible, and loan privileges. Is that important? Should we be using our retirement plans to borrow against? And I strongly suggest you don't. Ideally we get our emergency fund first, and then we try to leave our retirement plans for retirement. And I know people who get to be 55 and 65, and they've borrowed against their plans, and so they have very little left for retirement. So let's not try to set a goal that you won't borrow against your retirement plans. Okay, so let's talk about some little details on these. So for your 401k, 403b, and 457 plans, here's kind of a history of what's the amounts and the catch-up contributions. So we all remember catch-up contributions when you're part of the OGC, like me. If you're over 50, the government's trying to give you, encourage you to save more. So if you're over 50, you can save an additional $5,500 each year. And any thoughts on vesting? What's vesting? Someone want to define that for me?
Isn't that when you spend a little bit of time at a company, and after a certain time period you can start actually putting money into the contribution?
Close. Steve.
It's the amount of time that you have to be working for the company until the match is actually owned by you.
Right. The amount of time you're working for the company until the match is owned by you. And so how about the money you put in? How soon is that vested? Immediately. So you could take that any place. Generally what we have, normally there's two major schedules, although it can be different with different companies. So these are kind of the major ones. If you've got graded vesting, after the first year it's 20% yours, after the second year it's 40%, 60%, 80%. When I left my previous company in Washington, D.C., when I came here, I got a check. And it wasn't 100% of the amount, but it was the amount that was vested. And if you can also do a cliff vesting that says, okay, you're vested 100% at 5 years. And so notice these numbers can differ. And so different corporations can set up the vesting schedules different. How about tax considerations? When do you pay tax on a 401k? When we what? Yeah, when you take it out at retirement. Notice though, what this does is this, most of the time we put this money in for 30 years or 40 years. Theoretically, most of it's likely capital gains. However, when we take it out at retirement, what does it magically change to? It changes to ordinary income. If you take for example, a traditional 401k, if you take it out before retirement, there's a 10% penalty, and you have to pay taxes on it too. How about if you move from, if you're in company A and you want to move your retirement, you just took a job with company B. If you tell them to write you a check, notice that there's a 20% withholding tax. When you give it to this other company B's plan, do you have to make up that additional 20%? The answer is yes. So the best thing to do is, we'll talk about when you transfer from one account to another, instead of taking a check, if you just have the custodians transfer it, it's a lot better. And then they have what's called required minimum distributions. And what a required minimum distribution is, the government gives you this tax benefit that you don't have to pay taxes on this earnings. But they say once you reach age 70 and a half, you have to take out a certain amount. So what you do is you take all of your account balances as at the age of 69 and a half, all of your deferred, your traditional accounts, you add it up, and if you're at age 70, you divide it by 27.4, and that would give you how much you have to take out that year. And if you don't take it out, if you don't take that out that year, there's a 50% penalty on the minimum distributions not taken. So it's pretty high.
So why is that they want you to take it out so bad?
So you can pay the taxes on it. You know what they say, the government giveth and the government taketh away. So that's kind of our framework here. Question. Here's a case study. Deciding between a Roth 401k and a traditional 401k. Which should you select and why, and what are your assumptions that would impact your choice of vehicle? 5 different things. Questions to help us to make that decision. Thoughts on what those are? Great. Right, so what's your tax rate now versus what do you think it will be in retirement? If you think it's going to be higher in retirement, what do you want to do? Go with the Roth. If you think it'll be lower in retirement, what do you do? Traditional. Okay, question 1, tax rates. Question 2.
How much do you need the tax break right now?
Yeah, do you need the tax break right now? So, Jacob. So if you need the tax break now, which one is it, Jacob?
Traditional.
Traditional. If you don't need the tax break now, Roth. So that's question 2. Question 3. How about this? Do you have the money to pay the taxes now? So, because if you put it in a Roth, you're going to have to pay the taxes outside of the retirement vehicle, and some people may not. And that may be similar to the other one. Do you need the tax break now? So if you have the money to pay the tax break, then you can make the decision to go with the Roth. Question 4. Might you need some of the money before retirement? If you put it in a traditional and you take money out before retirement, and I don't recommend you do this, but what do you have to pay? 10% penalty plus taxes. If you've got a Roth, you can actually take contributions out, not earnings, but contributions out without penalty and without taxes. And then the last one, do you want to save more for retirement? How can a Roth help us save more for retirement?
All grows tax-free.
Yeah, so it grows tax-free, but where do we pay the taxes? Do we pay the taxes in the vehicle or outside of the vehicle? So we're paying the taxes outside of the vehicle. So that $17,500, since we're paying the taxes outside of the vehicle, we're actually saving more than that $17,500. We're actually saving $17,500 plus the taxes. so we're actually saving more. Yes?
If you are to take out money early from a Roth,
Okay.
to put that back in, are you limited with the set amounts, or can you?
Actually, once you take the money out, you can't put it back in except based on the set amount, right? So, and again, is it a good habit to get into to borrow money against your retirement accounts? And I say no. Steve,
I'm still kind of confused about the taxation in these two, and like the way the gains are taxed.
okay.
What would be really helpful, I mean, you don't have to do this, but at some point, like showing like a timeline and then each taxable event in like the parallel of the two. But I'm just curious, like whenever you're taxed up front with the Roth, and is the Roth and the traditional, like are you paying capital gains taxes at the time you're withdrawing? Or like, I mean, you just kind of said it, but I'm just not sure if I'm understanding correctly. It sounds like when you pay into a Roth, you pay taxes up front, and then whatever grows inside doesn't matter, like you're never going to be taxed on it.
That's right. So let's just do a little spreadsheet as a spreadsheet to make it more usable or understandable. Okay, let's say our tax rate now. Well, so our tax rate now is 30%. We're going to do federal and state. And let's say our tax rate at retirement. And let's do our 17,500 here. So if you put in years till retirement, 35 years, if you put in $17,500 a year for the next 30 years, you'll have $3 million in a traditional account. Notice that what you'll do is you'll pay taxes of $904,000, because when you take that out at retirement, you have to pay taxes on it. And you pay taxes at your marginal tax rate.
And that's just on the lump sum gains?
Right, everything.
So even the gains, they're not even capital gains?
Nope, they're not capital gains. All they are, the government likes these vehicles because they change long-term capital gains into ordinary income. We don't like those because they do that. Okay, so if we do the same thing here with a Roth. Now the Roth, the assumption is we're going to put $17,500, but we're going to actually we're going to have to pay taxes of $5,250 here. So in reality, what we're only putting in is $12,250. And notice that $12,250 for 35 years at 8% gives me my $2.1 million, which is exactly the same as it's there. Now let's Steve, are you with me on this? So the assumption here is we're not really putting $17,500 in. We're actually putting in just $12,250 because we're paying the taxes now. Now what happens if a retirement tax rate is, instead of 30%, let's say it's 35%. Notice our tax rate in retirement is higher. So now we've got 1.96 versus 2.1 million. So now you can see how the tax rate here. Grant and then Reese.
So if you don't work for a company that doesn't match,
Right.
Would it just be better to invest this money by yourself, like into a mutual fund, so that you can just pay long-term capital gains tax instead of ordinary income?
So the question is, if your company doesn't have a 401k with a match, is it beneficial to do that? Or just put the money in a taxable account? What you might think about, Grant, is you might think about, remember the priority of money? The first priority is free money. And so since there's no free money at the company, then your second priority is tax advantage money. And then you make that decision. If you're married, you and your wife can put up to $10,000 in a Roth IRA. So what we taught with priority of money is fill the next highest one next. So you can put $10,000, $5,000 each into a Roth IRA. And then if you have more money for retirement, then you could go back and fill that 401k as well. The key is to be wise here.
My question, you kind of answered it, but because I remember you saying you can only put 5,000 into the Roth. So
Right.
Here you've got 17.
Right.
So that's with the company, that's not an individual Roth.
Right. So this I'm assuming here the company will allow you to, the company has a 401k plan or something like this. Now, back to my question that said, which of these can you actually save more? if I pay that tax outside of the retirement vehicle, which of those could I actually save more? Actually, with the Roth vehicle.
So it's your choice to pay the taxes outside of the Roth? or
Right.
it's-
Right, so you could either, I'm paying $17,500, I'll take $5,250 to pay my taxes now, and really I'm only going to put $12,250 there.
And when you decide that as you start the Roth?
Yeah, so you make the decision as you start the Roth. Okay, so does it make sense?
So kind of a typical course of action, if like the employer has, the priority of money stuff, if an employer has, a match for situation 401k, but not a Roth, I'd imagine you probably take the match,
Okay.
it's free, and then what a typical thing you maybe like to set up a Roth IRA.
Yeah, you would. Now, can you do both? Can my wife and I do both right now? And we told you my strategy last class period is I want to convert as much money into Roth vehicles as I can. And I've got this really cool Roth 401k. So even though I'm living on my income but not my BYU income, I'm maxing out that Roth 401k. And then I'll take some of my taxable money to live on so that I can put as much money into that 401k as I can. Steve?
So it seems to me just because we always talked about not taking risk in this class and just being safe, and I have no way of forecasting what my tax rate will be just because the government can change. So
just out of curiosity, how many people with all the budget things going on and the fact that the government's spending 60% more than they take in, how many people think taxes are probably going to rise? Raise your hand. There's a class consensus right here.
So it's a safe bet, but I'm just saying that it seems like based on the principles I've learned in this class, I would just feel like it's a perfect hedge to pay half in one and half in the other.
You could.
And then, no matter which way, because it seems like that's a perfect
You could.
teeter, where, you'll just hedge your bet.
And actually, we'll spend a little bit of time on this, but a certain percent of your money, our tax system is progressive. So we know exemptions, $4,000 each, and then you've got a deduction of roughly $12,000. So if you put $19,000 roughly, you can take $19,000 out of a traditional IRA and pay no taxes at all, just you and a spouse. And then you can take another $17,400, add that to it, and you're only paying 10% tax on that next $17,400. So, so at retirement. So what we can do is we can actually manage our tax rates. And so my goal is somewhere around 60% traditional and 40% Roth. And so by doing a balanced program there, we can actually minimize our taxes. And so that's why, I'd encourage you to just think about that. But you want to have some both. And so, but my priority right now is I'm trying to max out as much of my Roths as I can. That's my strategy prior, so my wife and I are still on the accumulation side. And so our strategy is to try to accumulate as much in the Roth vehicles as we can. Okay, and so we talked about this one here. Let's say your tax rate in retirement is less. 25% in retirement versus 30% now. Notice here that the traditional is better. And this is just Learning Tool 28. So if you want to take a look at it, you're welcome to do that. So, questions on qualified retirement plans. Again, they're set up by the company. You've got defined benefit, defined contribution. And again, what we need to do is we just need to understand the vehicles, understand how we can do that. And understand we have to make some assumptions on what we're doing. So how about individual plans? So we've talked about a little bit about IRAs. How many different kinds of IRAs are there? Yeah, too many. There's lots. There's Roths. There's traditional. There's spousal. There's rollover IRAs. There's lots of different kinds. So let me just give you an example. When I moved from San Francisco, my company had a 401k plan. So when I came here to Utah, what I did is I set up a rollover IRA that I instructed the custodian to request the funds from my 401k at my previous company, and then they transferred the funds over. Because the custodian did that, did I have to pay that 20% withholding tax? And the answer is no. So let's talk a little bit about these individual retirement plans. Notice it's for 2013, we're up to $5,500. And again, if you're over 50, you've got that contribution, that additional money. When can withdrawals be made? Anytime after 59 and a half. Prior to 59 and a half, you've got 10% penalty, and then ordinary income taxes apply. So it's hard to believe in a year and a half I could take money out of these accounts. Scary. You can also do they can take some qualified education expenses. Notice with traditional plans, taxes are still required, but you don't have that penalty on some of these things here. And then with a traditional plan, you start taking mandatory distributions after age 70 and a half. Kia.
With mandatory distribution, can you take the money and put it back to like another Roth IRA?
Well, you can take it and put it into, you can put it in another IRA. And that way you don't have to pay taxes on that. So deductibility, the question is, we have to, in order to deduct that, you have to be making within certain limits. If you make too much money, they do not allow you to deduct your contributions. And what they use is what's called your modified adjusted gross income. And here's the limits. So 2013, if you make more than $69,000, you cannot single, or $115,000 married filing jointly, you cannot contribute to a traditional IRA. If neither you nor your spouse are covered by a retirement plan, there's actually no phase out. And if one spouse is covered by a retirement plan, then it actually goes to the Roth IRA limits. So just some things to realize that the government will give you these benefits as long as you don't make too much money. Now, if you have a Roth IRA, notice that the limits are significantly more. Instead of 95 to 115, it's 178 to 188. Now here's the question. If you make 188,000, that's your MAGI, can you deduct the full 5,000? What do you think, Howard?
I'd say no.
No. How about if you make 177,000? Could you deduct the whole 5,000? Yes. How about if you make 183,000, which is halfway between that? Can you deduct the full 5,000? And how much can you deduct? So you can half. So if you're in the middle here, you can deduct half of that. The closer here you get, you can deduct less. So realize that if you make right in the middle there, instead of being able to deduct the whole 5,000, you can only deduct half of that. Education IRAs, are we familiar with those? An education IRA is just like a Roth IRA, but you have to use the principal and interest for qualified educational expenses. Is this a good way to save? I like it. I've used it with my kids. And so, nice thing here, so remember how your AGI is calculated. You have to add back certain things: foreign income, foreign housing, IRA contribution deductions, and higher education costs.
So what's the difference between an education IRA and like the 529 plan?
Okay, an education IRA it's very similar to a Roth. Now, a 529 is similar to a Roth too, but most 529 plans also have tax benefits. So, for example, if I put $3,000 into a 529 plan in Utah, I can take a tax credit of 5% of that amount against my Utah taxes. So realize there's certain other benefits as well. With a 529 plan, you get a list of options, 10 or 15 options. With an education IRA, you're unlimited. And basically, most things you can put in an education IRA within some minor limits. But so one is much more you direct, and the other one is you pick options. But I use them both. I think they're both good plans. Okay, minimum distributions. We talked about this. We'll do a problem problem a little bit later. Question. Go ahead. You got a question?
So this is not morbid, but what happened if you and your spouse were the IRA?
Okay, so what happens with, it's actually a good question. So if you are thinking of leaving an IRA with your heirs, what's better to leave, a traditional IRA or a Roth IRA? So if you leave a Roth IRA, how hard is that to transfer to your heirs? It's very easy because the taxes have already been paid. If you do a traditional IRA, how tough is that? Basically what happens is you have to pay the taxes, then it goes into your heirs account, and I believe it goes in as an IRA as well. So they can't take it out until their age as well without penalty. So the Roth is a much cleaner vehicle to, if you want to leave money to your heirs. So when does converting to a Roth make sense? You know, you think your tax rate's going to stay or go up. Plan to wait at least 5 years before withdrawing the money. You can pay taxes. And you want to avoid a required minimum distribution. Here's the question. Does a Roth IRA have a required minimum distribution? Do you have to take those out at age 70 and a half? No, you don't. How about a Roth 401k? Does it have a required minimum distribution? At least from my understanding of the tax code, it still does. So what you do once you retire, you take that Roth 401k, you roll it into a Roth IRA, and then you don't have the required minimum distributions. The point there, that's just the law hasn't caught up with the vehicles yet. But here's conversion. You want to, if you want to convert it, you pay taxes on the traditional. And then you pay taxes on the traditional and you put it away. So transfers are allowed in 3 ways. You can accept payment and redeposit within 60 days. Trustee to trustee direct transfer, which is what I recommend. Or you can change the account designation. Excuse me, did I miss something? But when might it be a good idea? Remember we talked about my strategy, our mission strategy, my wife and I mission strategies. When you're on your mission, you're retired, are you going to have much income coming in? No, the only income you have is that you take out of those accounts. Are you going to have lots of expenses that are tax deductible? The answer is yes. So would that be a good time to take some of the money you've got in qualified plans in your 401k and traditionals and convert them into Roth plans? And I think it would be.
Sorry, last question. So how does tithing work with all this,
Okay.
as far as like retirement plans? So I know you said before like that you think it's best to pay tithing on your net income, but if you pay that and you're investing some of that,
It's
and
hard.
do you pay tithing on your capital gains because you don't want to pay it on everything and take it out because you want to pay it on some of it?
And I'm not really smart in this area, but I have a good friend, and what he does is he just pays no tithing on his contributions. And then when he takes it out at retirement, he'll pay tithing on it. And so, which is probably what I'd recommend. Now, what I do and what I recommend are 2 different things. And what I do is I pay tithing on it all, and I figure we'll figure it out when we retire. But you figure it's his. And if it's his, it really doesn't matter. Let's do a little case study. Bill's got money in a traditional and a rollover IRA. Retired on his 60th birthday and didn't use any of his traditional balances. December 31st, he had $150,000 in his IRA. What's his required minimum distribution next year? How do you calculate that? So it's funny, you take your age and you add this to that, and it gets roughly what the government thinks your life expectancy is going to be. How much will you have to take out? Yeah, 5,470. And what happens if he doesn't take that out? Yeah, he goes to jail. No, actually not. There's actually a penalty, and what's the penalty? 50%. So he'll have to pay taxes on basically $2,700, which is not a fun thing to do. You know, so we've talked about qualified. How about small business plans? I did consulting work. I was, you know, a business of one. Are there retirement plans for individuals in small business? And how do they compare against some of the other ones? And the point here is there are plans both for individuals and for small businesses. And some are even better. Some even have more tax advantages than the large institutions. And so if you are self-employed, there are a number of plans that you can use, a SEP, a KEO, simple plans that are very similar to what corporations can use, and you can put a significant amount away. I had worked as a business when I came here back to teach. They paid me for that business over a couple of years. And I didn't realize that the first year, but I could have done a SEP IRA. And so I did it the second year. And I was able to put $25,000 of that away into a tax deferred account. And so, you know, I kind of kicked myself that I didn't do it the year before, but part of it is I just didn't know. So if I can help you guys to understand the vehicles that are out there, it'll make a difference. And two categories. One, they're funded by the small business employer. And two, that are funded by the small employer and the employee. So let's talk about employer. SEP IRA. This was the one that I used. I finally figured it out the second year. And so because I had money coming in from a consulting thing here, I was able to put a certain amount away. You can contribute up to 5% of your salary or up to $51,000 in 2013, whichever is less. And so, and that's significant. That's almost 3 times what you can do in the 401k. Tax deductible, earnings grow tax deferred, and employees own the plan. Since it's your plan, you take it with you wherever you go. Could you have both a Roth IRA, a traditional 401k, and the SEP IRA all at the same time? And contribute to all 3 of those in 1 year? Yeah, as long as you were under the limits. So realize these can be really good. The advantages of SEP, you go on to Vanguard screen, all you do is click what kind of an account is this, you click SEP IRA, and then you put the money in. That's how hard it is to put it up. So you have to be wise up there. Disadvantages, you can't borrow against the SEP. I don't have a problem with that. I don't want you guys to borrow against any of your retirement money. Steve?
How do they validate that you are a business? Like, do they require a social security number or an EIN?
Right. So all of these accounts all require that.
So they all require a tax ID number for
Yes.
a business?
Yep.
So if you're a sole proprietor, then you couldn't do it, most likely, because you would just have...
No, you could.
I mean, with just your social?
Just with just your social.
So, I mean, but anybody could do that. So that's what I'm just wondering how they would...
How they actually check, you know, for example, at the end of every year, if you contributed to a Roth or you contributed to a SEP, your institution actually reports that to the IRS. So they have ways of making sure that that's correct. And again, when I started, it was back in 2000. The minimum was $25,000, but you can see how that's continuing to grow. And so in 12 years, it's actually doubled the amount. Again, the government is feeling increasingly important that we take responsibility for our retirement, and they're giving us the vehicles to be able to do that. Then you've got a KEO plan. Sole proprietor or partnership. And again, tax deductible payments to retirement plans. Characteristics, you can set up, again, 20% up to $51,000 per year in 2013. Give the same percentage to each employee. Tax deductible, earnings grow tax deferred. And employees can borrow from the plan, although I don't recommend it. again, advantages and disadvantages, you guys can see that. And then there are plans funded by both the employer and the employee. And now what we've got is we've got simple plans, savings incentive match plans. And again, notice here that the amounts on here are smaller, but I think the government is moving to try to incorporate these to very similar limits with the qualified plans. And so here with the simple, you're required to either contribute at least 2% or match employee contributions up to 1 to 3%. And again, you can see the limits here, not as good as the 401k, 403b plans, but we're actually seeing an increase there. Again, as the government realizes we need to do more work here. So advantages, employees can contribute, taxable deductions. It's easy to set up and administer it. And what the government's trying to do is trying to minimize the requirements for small companies so that they can encourage people to do this. Again, same penalty. If it's withdrawn before age 59 and a half, 10% penalty, and you're taxed at it as well. And then you've got a simple IRA. Again, same limits. You know, and I'm not sure the differences between the 401k and the IRA, the simple here. But again, it basically runs very similar to what we had before. And let's go back to this original case. How would you respond to the question now? Sure. So the contribution amounts, one is for an individual and one is for a small business.
So it's just it's easy to carry with you, but
Yeah.
now you don't get more tax benefits.
Yeah.
Less.
Yeah. So, and again, what's the government trying to do? The government's trying to encourage us to save. And some of the efforts are movements in the right direction. And again, I actually think these simple plans, the limits need to be increased up to the same levels as the qualified employee plans. And I actually think that that's the direction we're going. And I also think that these limits need to be increased too to encourage more people to save. Of course, what do you think is the bigger drag on retirement spending? Is it the fact that the limits are too low or the fact that people are saving too little? Probably that people are saving too little. And we have to get back and realize that this, the size of your house you have and the kind of car you drive and all of these things don't make an impact. What's important is, are we accomplishing the things that Heavenly Father wants us to do? Last night I'm a home teacher to a wonderful lady. So last night my home teaching companion and I went and installed a toilet. So Kermit's my companion. I joke that I bring the tools and he does all the work. And what was interesting last night was the discussion. After we installed the toilet, we sat and talked. And she made an interesting comment. She says, you know what, I feel really bad that I haven't accomplished the mission that Heavenly Father wanted me to accomplish. And I thought about that. I think there's a lot of people out there who feel that same way. That things have gotten in the way, and she's had a rough life. Divorce and raising kids on her own and things like this. And I said, but this is where the atonement comes in. I said, the key is don't worry, don't look back, look forward. What can you do now? And what are the things, and we talked with her and we set some goals and things like here. But her comment was, I feel really bad because there was things that I should have done and people I should have helped that I didn't. And I think that's what we need to think about now. What are the things that we're supposed to do? And what is our mission? Why are we here? And I can tell you that it's not he who dies with the biggest portfolio wins. Or who dies with the largest house wins. Or she who dies with the most clothes. You've heard all the jokes. It's, are we using the resources to accomplish the mission that our Heavenly Father has sent us here? And so as we think about these things, you know, it'll be sad if you retire and you don't have the resources to be able to do the things you want. You don't have the resources to serve missions. You don't have the resources to help your kids. So the key right now is really thinking about it. What can we do? Probably the single most important thing is, are you living on your budget? Are you saving whatever your goal is? And again, I still recommend that 20%. And probably one of the biggest things is once you graduate, keep living like a student. Someone said, you live like a student for the first 10 years after college, you'll live like a professional afterwards. You live like a professional for the first 10 years after college, and you'll live like a student afterwards. But, you know, and that's the key, is we get used to it. So, point here, again, a lot of materials today. I apologize, there's so much, but a lot of little details. And our goal today was really to understand what are the investment vehicles we can use to save for retirement. And so next Tuesday we'll have one more class period on retirement. We'll spend time on Social Security. If there's any other questions you have on retirement planning, if you'll email those to me, and I'll make those part of our presentation on Tuesday. Questions? Thanks, everyone.